Hello, can you hear me now?
Yes, Saiful.
Hello?
Yeah,
Yes, very good. I hear something. That's a good sign. So both works.
Good afternoon, good morning, depending on from where you are joining, and welcome back to the new era of agriculture commodity trade. Welcome to the session 2, day 4 of Commodity Week World 2026 or CWW 26. Just a visual and a mic check. Neeraj, am I audible as well as visible?
Yes, loud and clear.
So early today, this global marathon kicked off day 4 by uncovering the intense crush margin pressure and mandated dynamics across the Asia and Pacific corridor. Now we turn our sight to the EMEA theater, chasing the sun to map out a critical, fast-evolving ecosystem of trade. The session shifts the spotlight to a vital regional dynamics, demand in Europe, and shifting supply and import flows across Africa, and on sustainability and production aspect in the global south. The agriculture value chain has crossed a critical threshold. The traditional playbooks, the one that relied on predictable crop cycles, stable freight corridors, and reliable trade alliances, have officially expired. Trade is no longer observing cyclical market corrections. Operations are running within the baseline of permanent and structural volatility. Over the next 3 days, our tactical sessions will continue bringing the global boardroom directly to your screen. CWW 26, organized by HnyB Tech Incubations and Know Your Commodity, is presented by AgriGuru Online and is supported by Kripco Agri, Bajrang Group International, and Bingani Group, along with our association partners, OTA Myanmar, Ukraine Pulses Soybean Association, and GOPKI Indonesia. Other institutional partners include Solidarity and World Cooperation Economic Forum. CWW 26 is moving entirely beyond the delayed data of historical balance sheet and presentation. This is an unscripted, unfiltered boardroom. The mission is to democratize the high-stake market intelligence, mitigate the systemic risk of information asymmetry, and equip you with the foresight needed to defend your margins and ensure equity for producers and consumer alike. As a reminder, these sessions are being live across multiple digital assets on LinkedIn, YouTube, X or Twitter, Facebook, and event website. The macro view: while grain represents the baseline of caloric survival, oilseed and vegetable oils are ultimate drivers of agriculture processing margins and the primary target of the global energy transition as well. The energy sector has rapidly emerged as the fiercest competitor for food and feed, including widespread feedstock anxiety across the globe. Globally, the oilseed balance sheet is expanding to meet this demand, but supplies remain incredibly tight related to the consumption. According to the latest figure from USDA and International Grain Council, the global major oilseed production is forecasted to increase by 19.6 million tons to a record 718.1 million metric tons. Let's look at the breakdown of these numbers. Soybean production represent the vast majority of this increase, rising nearly 14 million tons, mainly from Brazil, the United States, and Argentina. Sunflower seed production is also rebounding, set to increase by 7 million metric tons, driven by recoveries in Ukraine, Russia, EU, and Argentina. Meanwhile, the rapeseed and canola area is growing 4%, but the global production is only growing by 1% or roughly 1.4 million metric tons. As a major producer return to trend yields after previous high. On the processing side, combined global oilseed crush for the major varieties with soybean, rapeseed, sunflower seed, etc. is projected to increase by 4% on back of higher product demand. The structural volume growth includes expanding sunflower seed crush right here in the EU, Ukraine, and Russia. In the vegetable oil trade, palm oil still remains the world's most traded vegetable oil, accounting for about 50% of global trade. The structural revolution in this complex is driven by a fierce competition where biofuel mandates anchor the domestic supplies in major producing nations, shifting trade patterns and forcing international buyers to dynamically recalculate their destination options. Which brings us directly to the theater of our second panel. Welcome to the EMEA theater. Here in Europe and Middle East and Africa, the oilseeds and vegetable oil narrative is defined by deep import dependency, structural regulatory shifts, and evolving cross-border origination pipelines. Let's break down the critical EMEA pressure points. First, Europe demand and the crush equation. The European Union is a massive destination hub for global oilseed, with EU soybean imports forecasted roughly around 13.2 million tons for the current cycle. European crush facilities are expanding their sunflower seed processing to capture shifting product demand. However, the European market is no longer just solving for price and crushing margin. The implementation of strict sustainability parameters, including the European Union Deforestation Regulation or EUDR, has introduced immediate execution hurdles. Navigating these strict tracking framework is splitting the global trade into distinct certification tiers, forcing European buyers to secure bulletproof supply chain while ensuring their feed mills and refining operations remain fully covered. Second, let's talk about North Africa, where the import squeeze is there. Across North Africa, we are seeing heavy processing and consumption hubs like Egypt and Algeria are facing an increasing procurement battle. According to the institutional balance sheet, the imports of soybean and key vegetable oils are expected to rise for Turkey, Egypt, and Algeria. Specifically, look at Egypt and Algeria, where domestic soybean oil production sits far below the consumption requirement, leaving them structurally dependent on foreign oil import. These buyers are navigating these tight global supplies while simultaneously managing several local currency devaluations and macroeconomic frictions, making daily risk management a matter of financial survival. Third, let's talk about supply and processing pivot across Africa. The African continent is increasingly moving away from being purely an importer of refined product to scaling up its domestic crushing infrastructure and regional agriculture supply chains. Local processors are attempting to build defensive moats by investing in domestic oilseed origination and primary processing, looking to shield themselves from global feedstock anxiety and volatile ocean freight spreads. The integration of local African production of soybean for non-GMO refining network is redrawing the traditional trade flows, turning the region into a highly dynamic frontier for both seed origination and oil processing. So the days of relying on lagging monthly report to make multi-million-dollar procurement or hedging decisions are over. Navigating this tight and highly regulated market requires elite ground-level foresight. We are going to extract that foresight right now. We have assembled an elite strike force of EMEA, oilseed, and vegetable oil expert. We have the originators managing the cross-border flows, macro analysts decoding the shifting balance sheet, the corporate leaders executing large-scale procurement amidst this regulatory and macroeconomic chaos, and industry voices working on sustainability aspect. Our mandate for the session remains identical. No script, no filter, pure intelligence. We are going to dissect the European demand metrics, evaluate the evolving processing footprints across Africa, and uncover the critical arbitrage opportunities hiding within the current trade disruptions. To our live audience, please engage with the data and prepare to rethink your coverage strategies. The market does not wait, and neither should you. It is time to secure your strategic edge. Welcome to the session 2 of Day 4 at Commodity Week World 2026. Let's officially open the oilseed and vegetable oil Europe, Middle East, and Africa war room. With that, I would like to first invite my first speaker, Siegfried Vogt. He is a world-renowned commodity analyst serving as co-editor at ISTA Milk GmbH, which is also known as Oil World in Hamburg, Germany. With a celebrated career tracking global oilseed oils and fats, he is a leading authority on supply-demand modeling, price trend forecasting, and macro data interpretation for 39 distinct oilseed. His independent research and analytical insight formed the foundational basis for high-volume commercial trading and policy-making decisions across global commodity trading network.
Hello, Deepak. Thank you.
Hi,
Thank you very much.
Hi, Siegfried. How are you? Hope you are doing awesome.
I'm fine. Thank you. Thank you for inviting me, for having me here, and great welcome to all participants here who join us. Deepak, before we get started, can we just make sure that I'm able to share some slides? So this may be more
100%. Sure.
More beneficial than just looking at my face.
Yeah, I totally
all
agree.
the time. Let's see.
Yeah, now you can share. Please go ahead.
Okay, hold on a second. To move this one here, and here we go.
Yeah, perfect. Awesome.
Okay. We got that far.
Can you just make it full screen? You would be having on your right side a small button to make it full screen. On the bottom.
Hold on.
Yeah, if you can see that the fourth button on the bottom right of your screen, just, yeah.
It doesn't seem to react. Hold on a second. No, this was not it.
Okay.
I can't seem to find the correct button.
Yeah. Just next to this slider, the first button on the left to the slider. Bottom slider, the first button left to the bottom slider.
To the bottom slider of the slideshow, right? You're on the slideshow.
No, the bottom, exactly bottom of the screen. There is a which shows percentage, na? The slider which shows percentage. The one just next to that, you can just click that.
I'm clicking on it, but it does not seem to
reacting. Not a problem. We can continue. Not a problem. Please go ahead.
You can see it now on a smaller scale.
Yeah.
Okay. Well, I'm sorry for the inconvenience.
No, not a problem. Please go ahead.
If I can draw it a little higher.
No, this is perfectly fine. You can just proceed. Not a problem at all.
Okay. Okay, Deepak, would you like to start the discussion with your questions?
Yeah,
how should we proceed?
You can go with the presentation, and then we can, if we have time, we'll definitely get into the question answer. Please proceed with your presentation. All yours.
Okay, well, thank you very much. One of the key questions, obviously, for all market participants is now currently which one of the commodities is now in the driving seat. So I would like to draw your attention now, first of all, to palm oil. I think this is the commodity to look at for all stakeholders at the moment. Now, why is this the case? The price development is already telling us something. The CPO price in Indonesia has moved again to a premium relative to soy oil in Argentina. So the experience of the past, when we got accustomed to huge discounts of palm oil, this period seems to be over for now. And this has to do with structural changes within the palm oil sector. So first of all, we have to look at several trends which now come together in the palm oil industry. So there is a longer term problem affecting palm oil production both in Malaysia and Indonesia, and that is the lack of replanting with the effect of aging tree structure. And this is quite obvious in the left-hand chart in the longer term downtrend of average palm oil yields. So this has clearly flattened the curve of growth of world palm oil output of late. So this factor is now being compounded by the increasing involvement of the Indonesian government in the palm oil industry. First of all, this started with a partial removal of private property in the palm oil industry. The Indonesian government was seizing parts of the palm oil area. And now, more recently, the Indonesian government has announced to take over the export sector. We don't know yet what this will mean exactly. We have to wait what happens. We are still in the transition period. In September, palm oil exports will only occur via state agencies. So what this all means is it negatively affects the investment sentiment. So palm oil plantations are cutting back on fertilizers for several reasons, because they don't know what happens in the future with their plantations. And secondly, because fertilizers are obviously very expensive and very tight in supply at the moment. So this is now having severe repercussions on the palm oil supply and demand balance. Now, it appears that in the course of this year, the domestic consumption of palm oil in Indonesia will exceed the level of Indonesian palm oil exports. The production growth, as I said, is flattening. It will probably decline on the year in 2026. So this steep increase of domestic consumption, which we are now expecting, is primarily driven by the move of biodiesel admixture from 40 to 50% from July onward, which has just recently been announced by the Indonesian government. So we have to be very concerned about the availability of palm oil on the world market. And we should not forget that this is not only a problem in Indonesia. Also, Malaysia and Thailand have recently announced to step up biodiesel production based almost exclusively on palm oil in response to the crisis in the Middle East, in response to the fuel shortage. So, as a result, we expect world exports of palm oil to decline by at least 2 million tons in April, September 2026. So this is in significant contrast to the massive increases we have seen in palm oil exports during the past 12 months. So consumers have to adjust to this change. And what is probably even more concern is that the alternatives are quite tight as well. So this shortage of palm oil exports on the world market can barely be offset by competing vegetable oils in the months ahead. So biodiesel is obviously a key factor that has changed price making and market analysis. It is in the headlines because biodiesel production is booming in the United States, but we should not forget that biodiesel market is an integral part of the vegetable oil market for many years already. As you see on the chart, the production growth rate in biodiesel has fluctuated, but has been significant at 4 to 5 to 6 million tons during the past 10 years. Last year was an exception when the US biodiesel program was not yet clear. Then we saw a setback, and this is making the increase registered this year even bigger. So, in other words, the share of biodiesel in total vegetable oil consumption has increased significantly over the past 20 years. It is now absorbing roughly 20% of total vegetable oil consumption, only for fuel. So this is, of course, raising the vulnerability of our markets to developments in this sector. So, and what is probably the most alarming development at the moment is that this biodiesel boom in the United States is driven by a binding mandate. In the past, we sometimes had biodiesel consumption grow and fade as soon as vegetable oil prices, feedstock prices have appreciated and become too costly. But nowadays, we see with this binding mandate, there is no price elasticity any longer, at least to a certain point. Biodiesel producers just keep pushing higher, and we see a separation of markets. that's why we see such a huge divergence of prices of soya oil in the United States versus those on the world market. A huge premium of more than $500 has developed recently. So what this also means is that vegetable oil markets in general and palm oil in particular have been relatively closely linked to developments in the energy sector. The competitiveness of palm oil and other vegetable oils versus gas oil has clearly improved since the start of the Iran war recently. Now, whether this strong competitiveness can continue or not remains to be seen. It is probably no exaggeration to say that in the longer run, the competitiveness is unsustainable that we currently have because the production growth in vegetable oils is just too limited. Otherwise, we risk losing too much demand price-wise in price elastic segments of the energy field on top of that demand growth driven by the hard mandates like in the United States. So what does this mean for the oilseed market in general? Now I talked of the fading growth in palm oil production and even more so of the fading growth and the prospective decline in export supplies of palm oil. Now, at the same time, a huge share of the biodiesel production growth in North America, as well as in South America, is based on soybeans. Now, what does this mean for the oilseed market? This has become a huge challenge. And this is behind the diverging demand trends we're seeing here between edible oils on the one hand and oil meals on the other. Oil meal prices are just slightly above average, while those of edible oils are more than twice as high as the average of late. So this has clearly to do with the crush economics. We are focusing here today mainly on vegetable oils, but we cannot ignore the flip side of the developments in the oilseed industry. Oilseed crushings, and in particular soybean crushings, are boosted to record levels to satisfy the magnitude of demand for soya oil, primarily from biofuel producers. But this can only occur as long as processors find sufficiently strong demand for their soya meal. So again, this extra demand for meal can only be generated via very competitive prices. And at the same time, this means for crush margins to be attractive enough, vegetable oil prices have to be comparatively firm. And this is what we currently seeing happening in the market. Only yesterday, the oil share of the combined soybean product value for soya oil increased on the Chicago Board of Trade to a new high of 55%. Very extreme developments. So it is luckily for consumers, not everything bullish what is currently shaping up in the market. A turning point is probably shaping up in the sunflower seed market. The area under sunflower seed continues to increase, promoted by the attractive prices by the high prices for sunseed and sunflower oil seen during the past 12 months. Last year's crop was clearly a disappointment, primarily in the Black Sea region, because of widespread dryness. Production there was highly insufficient to satisfy demand for sunflower oil, despite an increase in the area. Now, this year, the acreage is increasing further to a record level, and under normal conditions, which we can currently expect, we are forecasting a record production of sunflower seed, and this will be very beneficial for consumers of vegetable oils in the upcoming season. We can already see this have an impact on prices. Only recently, sunflower oil has become cheaper than rapeseed oil. So there's a structural change in the price structure of vegetable oils already underway, and we expect this trend to continue, at least as long as weather conditions remain generally favorable in the key production regions of Russia and Ukraine. Now, the other commodity we see here, rapeseed oil, is a different story. It's probably a rather supportive to bullish factor for our markets at the moment. Probably still somewhat unexpected, because we have a good crop in Europe. We have good crop coming up in Canada, but we should not forget that a growing portion of the Canadian canola crop will be absorbed by the US biodiesel sector. And at the same time, we see a growing risk of crop damage from dryness and from the repercussions of the El Nino weather phenomenon on the canola crop in Australia. So processors in Europe and elsewhere, they must be concerned about tightening export supplies of canola in the key producing countries, Canada and Australia. And at the same time, rapeseed oil consumption in Europe is currently rising quite strongly in the course of increasing biodiesel production and in view of less competition from waste oils owing to import restrictions on UCO, etc. This is just a quick look at the increasing risk of El Nino. We already mentioned this. So what this all comes down to is still the basic analysis of fundamentals. How does production develop? How does consumption develop? And what is the net effect? Are we moving towards a surplus, or are we moving towards a deficit? And right now, I would argue we are still more likely to move towards a deficit of vegetable oils. So why is this the case? We have to look at the major countries to find out more about what is behind these production changes and consumption changes in this global vegetable oil balance. Here, when we look at the growth rates of oils and fats in the key countries, we see, if you want so, a two-class society. We see the by far biggest consumption increases developing this season in the United States and in Indonesia, at some distance followed by Brazil and the EU. In all these countries, the demand increases are driven by biodiesel production. On the other side, we see already today repercussions of high prices on demand in countries like India and China and many other countries in Africa, where less disposable income and coupled with high prices of vegetable oils are affecting demand. Therefore, we're currently expecting an unusually small increase of vegetable oil consumption in India at the moment. Now, how can we assess the further development? How can we detect turning points in the market? For instance, in the United States, there we are currently seeing a breakneck race between production of soya oil and consumption of soya oil, both to record levels. Now, traders and consumers will need to watch who is gaining the upper hand in this development. So, for instance, one indicator that will help detect us where this turning point is the development of soybean oil stocks in the United States. So, in other words, can crushing of soybeans continue at this pace? Do they find sufficient demand for soy meal? And on the demand side, when will soya oil prices be at the point where the profit margins of biofuel producers are squeezed to an extent that they slow down or even reverse the pace of expansion that is currently still required to meet these ambitious biofuel goals? So we are currently in the process of developing our first forecast for the new season to be released next week in our yearbook. Now, we are having great concern about the adequacy of supplies of vegetable oils in the next 1 to 2 years. The problems I mentioned in the beginning for palm oil, they are not going away easily. In contrast, they may aggravate because next year the production may be affected additionally if we get a strong El Nino, and if this El Nino brings dryness to Southeast Asia, then yields in the key producing countries of palm oil will suffer even more. Now, the question is, how can this be offset by the oilseed industry? How can the major oilseeds offset the shortage of palm oil in the months ahead? As I said in the beginning, in the near term, April, September, this may be hardly possible. There is not enough soya oil, not enough sunflower oil available to offset a shortage of palm oil. From October onward, it will be a different picture. We probably have sufficient growth in sunseed production and crushings to offset the shortage of palm oil, at least partly with sunflower oil. But then again, we have to watch what happens in importing countries like India. The Indian government has taken the right measures in recent years by promoting domestic production of oilseeds. In particular, production of rapeseed has increased sharply, and this has been very beneficial for the Indian vegetable oil market. So this is probably the need of the hour for importing countries like India to strengthen their independence and their self-sufficiency as far as possible, because the export supply of palm oil, which has been the backbone of vegetable oil consumers in India and elsewhere in Southeast Asia and Africa for so many years, has become more and more uncertain. Now, having said this, the preconditions have been set for further uptrend of oilseed production in India. But what if this is counteracted by poor weather conditions? Deepak, you know much better than me, India is currently suffering from a heat wave. The monsoon is delayed already. So we have to be very concerned if this indeed affects Indian kharif production and possibly even rabi production, if water reservoirs cannot be replenished in the upcoming season. So this is basically the quick summary, focusing on some of the most relevant points affecting our markets, in my view, in the foreseeable future.
Perfect. Thanks a lot, Siegfried, for such a awesome presentation. Just one question before we let you go. How do you see, like, Europe coping up? Because there is a challenge in Europe also on the availability, because as the palm impact India, it does impact Europe as well. But at the same time, you are seeing a local production of sunflower seed increasing. Do you think that will be in a way able to take care of whatever deficit you see from either soybean or for that matter, like, even palm oil?
Sorry, I didn't fully understand the question. It was about the sunflower oil consumption
No,
in
I'm
Europe.
talking, yeah, in Europe. How do you see Europe coping up? Like, do you think that in Europe also we might have possibility of shift happening more towards sunflower from other I would say commodities in the basket?
Well, we have to acknowledge that the flexibility of the European market is not as big as in other countries when it comes to sunflower oil usage. It has been very strong and very resilient to price and changes in recent years. The sunflower oil consumption in Europe has been on an uptrend, and I don't see a reason to expect this to change in the foreseeable future. The European industry will take advantage of the prospective increase in sunflower oil supplies also in the upcoming season. And this has also to do with the limitations of the rapeseed oil supplies, as well as with the dramatic decline of palm oil consumption that has occurred in Europe in recent years, because the government regulations regarding fiscal support for biofuel have largely excluded palm oil as a source of energy. So a huge portion of vegetable oil consumption in Europe had to be replaced with other oils, and this has massively raised the dependence on sunflower oil in the European market.
Perfect. Thanks a lot, Siegfried. It was a pleasure having you, and thanks for the insight. Looking forward to your upcoming estimates. And I believe, it will not scare us more than already we are scared. Thank you.
Thank you very much. All the best to you.
Sure. So now we have our next speaker, another distinguished community professional, Sri Alok Bhargav, and he's a director at Praram AgriTrade DMCC in Dubai, a qualified chartered accountant and agriculture graduate with over 20 years of global trading house experience. He specializes in strategic corporate planning, financial risk management, and international business negotiation. His expertise focuses on designing integrated trade solutions that link storage infrastructure, advanced logistics, and food processing assets across international grains and pulses network. Welcome, Alok ji. Pleasure to have you, sir.
Yeah, thank you very much.
So, sir, straight away in the first question. So, soybean has reversed not just pricing trend, but the dynamics of origin and destination also. How do you see India as a large buyer for African non-GMO soybean?
Yeah, this is a fact now. The soybean trade is undergoing a sort of the structured shifting. Traditionally, global soybean oil, all the flows were dominated by South Americans and the United States and the Brazil and all those countries. But they were supplying to China and other Asian markets. But today, we are witnessing a much more fragmented market, which is, of course, driven by geopolitics, the climate variability, the biofuel demand, and changing consumption pattern. So India emergence as a potential importer is a particularly interesting because it changes the traditional perception. What we have about India is that India is only a producer and processor. So this is rising demand coming from poultry or dairy or feed sector is increasing the need for protein-rich raw material, while domestic production growth has not always kept pace with the demand. For Africa, of course, this present a significant opportunity. The countries like Tanzania, Zambia, Benin, Togo, Malawi, Nigeria, and all other countries, they possess substantial untapped agriculture potential. Their geographical proximity to India creates a freight advantage and the transit advantage as if we compare with the South Americans and the US origins, particularly during this period of the volatility and the elevated ocean freights scenario. But however, believe that India's buying decision will always be dependent on three factors: the consistency of quality, protein levels, the reliability of logistic and export infrastructure, and of course, competitive landed cost versus domestic alternatives available there. So I do not see in Africa soybean basically replacing Indian production, but I do see it becoming an important balancing origin that enhance India's supply security while creating new market opportunities for the African farmers.
Quite well taken, Alokji. And as you are aware, that India predominantly has been protecting its market for our farmers.
Yeah.
But
Yeah, of
unfortunate
course.
reality which has hit is that we just don't have just one soybean farmer to protect. We also have
Yeah.
poultry farmers to be protected, and also the challenges where inflationary pressure, because that in India the consumption of egg and the chicken and aqua is also pretty high, and
Of
that's a big
course.
industry. That is a pretty big industry. Now, my question would be from the again the same point, but the African perspective. In case India do look at say 800,000 tons to 1 million metric tons of imports requirement from Africa. Is Africa is having that level of leverage or capability to deliver at the right prices such a huge cargo?
Well, if I have to reply in a short answer, the answer is yes, but not without market consequences. Africa as a continent, we are not talking as a country, but we are talking Africa as a continent, which is consist of 54 odd countries there. Africa as a continent certainly can supply 800 or 1 million metric ton if the volumes are sourced from various countries. We are not saying East or West, we are combining all the countries and considering Africa as a continent. However, the market, often underestimate how quickly the incremental demand relatively affect small supply chains, because Africa, barring Nigeria, the production figures, if you see, is less than 500,000. Is only Nigeria, which is more than million ton as a country. If you combine everything, the production obviously will be having a good figure. So if India enters the market for close to 1 million ton, exportable surplus would quickly, origin prices will definitely strengthen. Farmer would receive improved price signals because they know there is more demand coming. More acreage would likely shift towards soybean cultivation, and local culture definitely will face a lot of competition if it happens. Because if you see in the West or if you see in the East, most of the countries have their own production capacity, crushing capacity for the soya beans. So in the short term, I would say that the market would likely experience a premium as buyer compete for available supplies. But in the medium term, higher prices would stimulate production growth and investment in Africa in logistic and storage and processing and all other facilities. So in short, yes, 1 million ton is possible, but then you will definitely you have to look into other factors like pricing and all other factors, because there is an equal demand in Africa as well. Africa is not producing like pigeon peas or like, this yellow gram only for the export market or mostly for the export market. Soybean is their own. They have their own consumption. They have their own factories. They have their own oil. Everything is there. So they have the capacity. Arable lands are there, and there is a lot of scope there already. If you look, last 10 years figures, the banyan has increased the production. If you start comparing year to year, you will see there is a growth in the production. So I believe, and 2 years back, 3 years back, India has already supplied more than million ton, more than 800,000. This year, I think Nigeria alone must have shipped more than 300 or 400,000 tons already. Which and another still the shipments are taking place. So the figure could become even more than this. This is only one country you are talking. I'm not combining, all the figures. If I combine, probably it will reach to a reasonable level of figure.
Perfect. So Alokji, now these are the economies actually when you see the challenge of the forex also. Being yourself a chartered accountant, understanding global trading pretty well, how do you see the challenges associated with the currency itself? Like, the devaluation of currencies. Even India is facing that. So like, on the both the sides, generally what happens is that at one side, you are having a country where the volatility is not too much, then you have to only see at either origin or at the destination. Yeah. No, here actually it's balancing. The both the sides are having like huge volatility in the your currency. Also the freight volatility, right? Suddenly we have seen because of Hormuz, it went up. Now it has stabilized. Still, it is above the levels of pre-war. But even you never know, like on one tweet or one social truth social post, right? The insurance premium changes, the freight cost changes. In such scenario, how to mitigate risk, the financial risk associated with the trade?
Yeah, Deepak ji, if you see, commodity trading today, it is no longer just about buying and selling physical goods. It's not there. It is now increasing a business of managing risk. It's not selling and trading. We used to say that trading is just buying and selling, but not now. It is now more of managing risk rather than having a trade, institute you have. So the most critical tools, including currency risk management through forward contracts and structured hedging. Natural hedging by matching, your receivables or payable in the same currency, or freight risk management through basically what I should say by the diversified shipping arrangements or rigorous stress testing, real time visibility of open position, and what is the liquidity requirements, what is the counterparty exposure, because everything is changing every time and every day. So ultimately, what I feel is risk management is not about predicting the future correctly, but it is about ensuring the business remain resilient even when the future becomes unpredictable. That's what I think.
No, interesting time, as you rightly mentioned, that it is about managing risk rather than actually getting into the buying trading zone.
Get into buying
And
and trading changes.
yeah, it's life is not easy, and especially like every
Not
day
easy.
you get up with anxiety that, and you first thing you do is that
Yeah.
you check the truth social, right? What has happened,
To
and then you go to
true.
Al Jazeera, then you go to Al Jazeera and see that actually what's
To
happening
verify.
to verify what is being said. So now that brings me to my last question to you, sir. What is the most
Okay.
common vulnerability you see in the financial modeling of mid to last year agriculture trading house today? We talked about the risk management, but it's
Yeah.
go beyond that, right? Still you have to trade,
Yeah.
right? Still you have to
Still
manage
you
the
have to
risk, and
trade.
at the same time you have to ensure that you deliver the product, because crises are there, but those companies which are able to survive crisis, they become big. So in your view,
Yeah.
actually, like how we can tackle such vulnerabilities going forward to still stand up
Yeah.
when the dust settles?
Yeah. I think the biggest vulnerability what we have is the assumption of normality. We are assuming that everything will be normal, which is not. So many financial models still assume that the financial spreads, exchange rates, basis levels, or the crop pattern will behave similar to the historical average. The past year has demonstrated exactly opposite. So the major thing is, the traditional thinking of us or our traders, that you analyze the last 6 years or 10 years or so many years of analysis and try to make your opinion doesn't work in today's scenario. So the second and the what second major weakness which I feel is the liquidity management nowadays. A company may appear profitable on papers, but still faces if receivables are delayed, or if the inventory cycle lengthen, or if the freight cost spikes, or the margin call increases, or we have seen in the this Strait of Hormuz for the last 4 months, we have some vessels and the cargo which is absolutely not moving. So neither you are getting money nor you are able to utilize that fund. So on paper, everything could be different, or in reality, it could be completely different because you cannot know from the balance sheet that the maybe $3 million or a $10 million cargo is stuck in Strait of Hormuz. Nobody will know. But this is what the reality of today's world is there. And so the strongest trading organization today are those who actually are focusing on the forecasting, were focusing less on forecasting perfectly and more on building flexibility on their business models. So the ability to adapt quickly has become a greater competitive advantage than the ability to predict accurately. So nowadays you have to be flexible. You don't have to be accurate. You have to be flexible. Some problems are coming, you change your attitude, you change your policy, you change your the way of working. But to predict accurately, I think it doesn't work nowadays.
So Alokji, if I've understood right, for large organization, if the decision making, right, is
Yeah.
decentralized to the level where someone who is facing the problem can take that decision rather than going through 4 levels of approvals,
Yes.
compliance, they would have a better chance
Compliance.
of surviving rather than actually someone who is not able to take decision because the corporate headquarters will respond next day,
Will
right?
respond next day.
They'll have a bigger problem. So agility,
Yes.
as Alokji rightly said, again, very sharp mind, being in trade and being actually trained chartered accountant, right? That shows on where actually it's advice to all, be more agile. In case you are CEO, don't worry to be sitting in your cabin, go and sit next to your trader
Yeah.
and help him take fast decision. That is the way to surviving. And I think this problem is not for next couple of months. This problem is at
Well,
least for more than 18 months. We are having
sure.
this war. I don't know when it is going to end. Then we are having El Nino. So you'll see that the chain of disturbing moment for the trading continuously coming. And even if
Continuously.
we go through all this, then you will be having a shock in the availability and then the inventories. Because as Alokji rightly pointed out, there would be cargo which would become non-usable after some time. And it is still there. In fact, Alokji, you'll be surprised. I was reading a report. Even the ships are suffering there. There is a formation of a different type of algae actually in the ship, right? If it is not clean,
Yeah.
then actually it damages the ship. And they are finding that 30 to 40% of ships are already, because they have not been moving, right, suffering it.
Oh,
And you have to spend 3 times more money sending someone, right, to clean it rather than bringing it
to
on the
clean it
port and
everything.
cleaning it. Yeah, so the challenges
True.
are multifold.
Too
And
many.
yeah. In fact, Alokji, also I'll take one opportunity of telling, a lot of people, they question why shipping prices are so high, why insurance are charging. See, they have to also ascertain their risk. If I'm a ship
Of
owner,
course.
right, I'm sending a ship in a war zone, I will charge more because
Yeah,
something goes wrong,
definitely.
right? I'll suffer. So yeah, it's interesting time. Thanks, Alokji, for putting the right
Thank you.
perspective. And the bottom line is be agile. That is what
Yeah,
Alok
be
Bhargav is
agile.
saying. Thank you, Alokji. Pleasure having
Thank
you,
you.
sir.
Thank you. Thanks a lot. Okay.
So now we have our next speaker. She is Nandita Madathil. She's a specialist in regional analysis of serving as a price reporter for EMEA Agriculture and Food at S&P Global Energy in London. She is responsible for driving daily price discovery and establishing independent pricing benchmarks for the highly volatile oilseed and grain sector for animal feed industry. Her core competence include real-time market reporting, evaluating the structural impact of European biofuel mandates, and analyzing cross-border trade flows to provide transparency for institutional trading clients. She will be making a presentation. Hi, Nandita. Pleasure to have you.
Hi, thank you so much for having me today. Thank you, Deepak ji. So I'll share my screen.
Please.
I hope my screen is visible now.
No, not.
Oh,
Not so far.
mm, uh, okay,
Yeah, now it is loading.
okay.
Perfect. You are on.
Thank you. So I would like to thank Deepak ji and Neeraj for calling me for this webinar, and I'm so honored to be speaking today. And good morning, good afternoon, good evening, everyone. I'm Nandita. I'm a price reporter with S&P Global Platts. I'll be discussing about the European soybean meal price, the price trends, the drivers, and the outlook for rest of 2026. So I'll be discussing about uh, the recent price trends, the demand, supply, the regulatory impacts, and what are the risks and what are the things you should be watching for rest of 2026 from the market. So before going deep into the market, I would like to give an introduction about S&P Global Platts. It's a price reporting agency. We started with oil and gradually increasing or expanding the markets to gas and then biofuels, metals, fertilizers, and then in agriculture, we spend from prices span from US to China. We have grain prices for corn, wheat, and we have rice prices for the major markets like India, Thailand, Vietnam, etc. And protein, we have beef, pork, poultry, seafood markets. And in the animal feed world, we have prices for Brazil and Argentina and Europe, one of the major destinations. I'm responsible for European animal feed market price analysis, and I'm covering the soybean meal and corn prices for Spain and Netherlands. But at the same time, I used to speak with Italian traders or German traders, different people to get a European across overview. Yeah, so now so this is a protein coverage prices I just put together. Like I have included the major origin and destination prices in here. Yeah, so now let's go deep into the soybean meal. So soybean meal is one of the major source of protein for animal feed, which is having a protein content of around 46 to 49%. And this uh, in the animal feed, which includes around 30 to 35 percentage, it depends on which animal you are speaking and what stage of animal you are feeding. And yeah, this commodity is going through ups and downs in the last few months, and starting with 2025 on October the 21st, EU Commission confirmed it will be implementing EUDR by December 2025. Deepak ji just mentioned about EUDR, but going back and understanding what is EUDR is. EUDR is European Union Deforestation Regulation, under which no importers are permitted to import the commodities which are produced from a deforested land. So when this came into place, the market went up by 10% in Netherlands and in Spain and all over in Europe. And no trades happening, no buyer interest, nothing. There were like few offers were floating in the market, and people were talking about what all the challenges will be, what will be the premiums look like, and you know how we can actually confirm or we can prove that is coming from a non-deforested area. So these were some of the things people were speaking about. And in just 1 month, on 25th of November, the EU Commission delayed it for one more year. So which means by 2026 December, UDR will come into place in two stages. On the first stage, it'll be implemented for larger companies, and after 6 months on June 2027, it'll be implemented for small companies. I'm not an expert on the the policies, so I'm not going deep into it. But after that, the market went down by 5% almost in both the region. But even after that, the market went down. It was correcting until the Middle East was started. It's not just for soybean meal, as people was talking about later. It was affecting every commodities, every life in globally, right? Yeah. So, but the sentiment I got from the market when I was speaking with the traders, the brokers, and the procurement managers of the major feed mills, they were saying that the buyers are taking a wait and watch approach because they had a few stocks with them. So they were like, okay, let's watch for now. Let's see whether we will get some stability from the market. But the war continued, the stock started to decline. So, which actually pushed the prices again. That's what actually you could see from the graph. So, the stock started to decline because of stable demand from the market and also because of high freight rate due to high oil prices. Importers were not in a place to like import a lot of bigger volume from Brazil and Argentina and other origin, and there were like a lot of delayed shipments happening from Brazil and Argentina as well. So this all contributed a hike in price for soybean meal in Netherlands and Spain. Not just these two countries, all over in Europe, but the price increased in Spain by 17% and in Netherlands by 15%. Uh, so which actually made the market to go inverse, which means the July prices are lower than the June price. So now the June prices are higher by 10 euros than the July price because people were telling me that few more volumes are expected from Brazil and Argentina in July, and there is a supply shortage in June. So, which is actually making the market inverse. And this is the current stage of soybean meal market in Europe now. So, now let's speak globally. Brazil and Argentina price are now different from the global commodity prices. In Brazil, the higher oil prices were actually affecting the domestic truck transportation, which actually increased the Brazilian soybean meal prices. But the delayed harvest and few, I mean, two ships which was carrying Argentinian soybean meal was detected with GMO gene in it, and this was not permitted to discharge in Netherlands port. Sorry, and in Italian port as well. So this has made a huge alert in Europe for Argentinian meal, and which supported the Brazilian soybean meal demand and price. And especially the Platts Analytics reported recently that the demand for Brazilian soybean meal is actually increasing in Spain, Netherlands, and Italy, and especially in Netherlands, it has doubled, which is something interesting we have to look for in the coming months. So talking more about the imports of soybean meal into the EU, let's look at the 10-year average data. So Europe is a total importer of soybean meal, and it is importing around 16 million metric tons in the last 10 year. And the contribution of Brazil is around 48%, and Argentina is about 36%. This is a 10-year average data. But if you look at the 2025-26 marketing year, the Brazil's contribution is around 56 compared to Argentina just 33. So can you see the difference? The spread is actually widening. It's because of all these things which I actually described just now. And you can actually see there is a huge import volumes in 2024-25 marketing year. It was because of EUDR anticipation. Then Europe imported around 20 million metric tons of soybean meal, especially from Brazil. It was because of EUDR, yeah, the importers and the traders and everybody wants to like stock before the EODR will come into place. They don't want to take any risk until they'll get some, understanding about it. So now let's quickly wrap up about the feed market. So supply, there is a ample supply is anticipated according to the USDA data, the Platts analytics data. The supply going to be ample. The demand is always stable in Europe because Europe Europe produces a lot of pork and poultry proteins. Speaking about proteins, another biggest challenge Europe has to watch for is African swine fever. The first, this ASF was reported on October 2025 in Spain, Catalonia, which is one of the biggest region for pork production. And then few cases were reported in January and then April and then early May. When I was speaking with the feed market participants in Europe, they were saying that no immediate effect was seeing on the feed demand in 2020 in Q4 of 2025 or in Q1 of 2026, but they are seeing a decline in feed demand now. So some of the traders were saying that the feed demand has declined by 2 to 8%. It again depends on which animal and which stage of animal you are feeding with. But the feed demand is declining now. And FIFAG, the Feed Manufacturers Association, FIFAG, they actually forecasted the 2026 pork production would decrease by 1.3%. This could directly impact the feed demand in Europe. So this is one of the major challenge Europe has to watch for in 2026, the rest of 2026. And EUDR is another uncertainty because we don't know much about EUDR, how the compliance will be, what are the challenges, again, the premium. Let's see what European Commission says about it. And the takeaway is ample supply, stable demand, but there are a few challenges to watch for. So stay alert. Before wrapping up, I would like to introduce you with the Platts soybean meal channel. Soybean is not just a commodity, right? It's a global talk whenever there is a US-China trade deal happening. So this WhatsApp channel will give you daily updates on soybean and soybean complex around the world, comprising Brazil, Argentina, US, Europe, China, everything. And you will get daily news and updates about prices and everything from the market. So you just do is scan the QR code and join the channel, and you will get the updates. So with that, thank you so much for listening to me, and I'm open for any questions. Thank you.
Perfect, Nandita. Thanks a lot for joining. Just one question, see, when you see the overall average, you said 16 million metric tons of import by Europe, right?
Mhm.
Last year it was 20. This year is already 13.7 odd.
Yes.
So there would be some carry left, which could, in case something goes wrong, could take care of the period.
So speaking about the stocks, the sentiment I'm getting from the market is that in Spain, there is few uh, vessels has already reached and they have enough supply now. So the prices is actually easing currently, but still there is a premium with June and July by 10 euros. It's just not for Spain, it is for all over in Europe. There is a supply shortage in Netherlands and in Italy. I don't think there is enough supply for now. I mean, there were a lot of delay, shipment delay was happening from Brazil and Argentina, but still there is enough supplies anticipated according to the USDA data. supply is enough, but it depends on how the freight rates are, how the oil prices, and how the feed demand will be. ASF is a big challenge to be watched for. So that could actually impact the feed demand and soybean meal demand hugely. Yeah.
Perfect. Thanks a lot. Really appreciate Nandita for participation. Very excellent presentation. And
Thank you.
I think more we are hearing, more worried we are getting.
Yeah, thank you.
So pleasure having you. So now I would be inviting our next speaker, and we are having someone who understands Africa better than none. Mr. Bharat Thakkar, he is a country operations manager at the Sun Impacts. He's having more than 20 years of experience in pulses, oilseed, and grain sector. He specializes in commodity origination across diverse regions, including Russia, Tanzania, Myanmar. His core expertise lie in end-to-end supply chain execution, identifying structural consumption shift, and delivering high-quality oilseeds, pulses, and to fast-growing destination markets. Welcome, Bharat Bhai. It's a pleasure to have you, sir. Sir, you're on mute in case you're speaking.
Hello.
Perfect.
Can you hear me?
Yes.
Yeah.
Yes. Loud and clear, sir.
Yeah.
So which part of
Thank
the
you.
world you are? You are in Myanmar, you are in Africa, you are in India, you are in
No.
Russia.
At the moment, I'm in India only. I live in Kerala, work for Sun Impacts for the Africa zone. I'm responsible for the Africa zone, all commodities, pulses, spices, oil seeds, procuring material from different parts of the Africa and selling to the destination market across the Southeast Asia and India subcontinent. So this is my role in Sun Impacts. And today, as far as our meeting is concerned, I'll be talking about soya bean, especially from India and Africa perspective. So altogether, if you put, there is a comfortable supply at the moment from across the globe. And specifically, I would be talking about a non-GMO category of soya bean supply chain from Africa perspective and India. Africa at the moment is comfortably supplying from east and west as well. Recently, East African also have started supplying from Tanzania and Malawi as well. And from the last 3-4 months, we have been regularly getting from West Africa as well. As Mr. Alokji just said that the 3-4 lakhs ton already traded from Nigerian side. Similarly, some cargo has been already traded from Togo and some part of Benin, but Benin has not yet started clearly. I heard recently there is some export permission is given to a few consignments from Benin. But yes, from India perspective, we can say that India has a bit different numbers while crop size and numbers were given by the different agencies. So originally SOPA had given a number of 110, 110 lakhs ton, 11 million metric tons. Whereas real time, some agencies have been telling that it is 95 and 95 lakhs tons. So altogether, around 100,000, even 10 million or 10.5 million ton also. The supply chain is comfortable at the moment, but there are some other factors which attracted Indian importer to import from Africa. That one of the factor was price. That price was very attractive at the initial stage, around 470, 480 level, or even 500 level. Indians were ready to import. And gradually, when the situation changed and some uncertainty on the crop numbers and coming crop harvesting and all monsoon reports, so crushers started accumulating the stock from import side also, and when market went up to the 740, 750, 760 level as well. But now again, assuming that the monsoon is started and probably soybean is such a product which doesn't require too much of water. So Indian farmers might switch to soybean from some other crop which requires a huge rain. So there is a possibility that sowing of the this soybean will be sufficient, or rather, I would say slightly better than the last year. So again, on a sentimental way, I can say sentimentally market is slightly pushing the price to the downside, but in long run, I think market is not likely to be so bearish, and it is likely to be in the range bound. Now, coming side of African side, Tanzania altogether and Malawi altogether, how much they are supplying, that will depend upon their government's policy and supply chain total factors. But as a whole, soybean is at the comfortable stage wherein supply chain there is no much hurdles, I think, as far as non-GMO is concerned. Now, export side slightly, I have been watching the numbers. The numbers have reduced in terms of meal exports because of the non-parity, and this GMO is affecting a lot of South American and US market is supplying GMO to the South Asian market, China as well. So our meal export is slightly reduced. So, and it is not competitive, and as a result of that, the price which went from 42,000 rupees per ton to 62,000 rupees per ton for soybean meal, now which has come down to around 60,000 rupees, and soybean seed which went up to 75,000 rupees per ton in Indian rupees, which has come down to today 70,000 rupees per ton. Second factor is affecting a very high volatility of exchange, rupee versus dollar, which which went up to 96.5, somewhere 97 also, right from the 1992, 91, 92 level. So that part also is very much affected to the importer, because most of our importers in India, they are all traditional importers. They most of the time they don't hedge the currency. They sometimes be open in the terms of all their imports cargo, and as a result of that, they have to suffer sometime. But yes, still there is a room for import also. I think this time Africa will be supplying more than 1 million ton. That is 100% sure. So far, I think numbers have come around 7 lakhs ton has been imported, and still the cargo is there. But in the slow pace, for the last 15-20 days, the pace has been quite slow in terms of offers, and even from the buying side as well. So this is the scenario of our soybean as far as India and Africa perspective. So any more questions? I'm really open for that.
Sure, Bharat bhai. So just a couple of things. So like, one of a trader who is your friend as well as Alokji's friend, right? He had a position between $560 to $600, I think some 40, 45 days back. And he asked me the question. I said, stay put, right? You will get good reward. It went up to 740, and then there is a correction. And the gentleman called me, भाई जी आप तो कह रहे थे तेजी है अभी, this is ये तो मंदी आ गई. So the problem is that actually you have to understand from the what price points which we're talking about. I still believe there is still a lot of gas, and sir, we see sowing numbers increasing in soybean for India for sure. But the another challenge is this El Nino will have the biggest impact in August and September. And this is the time when actually you need more moisture for the soybean crop. So we might increase acreage, but we might have a reduction in overall productivity and the yields. Second point which we talked about, sir, our number was less than 10 million metric tons in last year. So in fact, we have counted SOPA. When they have come out with the number, we said that actually this year soybean would be less than 10 million metric tons because actually there was a lot of acreage shiftage which happened towards the maize. Now this year, again, people a large number of them will get back from maize to soybean because one, the fertilizer cost or fertilizer availability is a challenge, and second, the weather itself. So based on these specific issues, we see that there could be a possibility of, again, not having a great crop. Now, with that context, how do you see the bottlenecks of the logistics, sir? Because actually logistics is also playing a challenging role, especially when it is coming from West Africa. East Africa is still not a big problem.
Yeah. East Africa
how do you
is
see? Yeah, how do you see that the logistic issues could impact the availability in longer run or shorter run?
See, at the moment, it is comfortable, but slowly, as I have been watching the supply chain from the shipping line, there is some disturbance and delay in the total supply chain from Africa to India. Earlier, what used to happen, we used to get cargo at within the 27 to 35 days from Nigeria, Togo, Benin, all these countries. Now, recently, it has been observed that minimum 40-45 days it takes, and that also sometimes it goes up to 50 days from Togo side, West African side. So supply chain is of course disturbed, as well as fuel cost has gone up, and as a result of that, all the shipping lines have increased their charges. Of course, it is obvious because of the fuel charges. Everything is gone high, so that also is affecting the price factor practically. So yes, supply chain is getting disturbed, but since a lot of trade has been executed, so the supply in the chain, it is continuous, and the cargo is keep coming. And in India also, in Navaseva, you see nowadays there is a lot of congestion because of this heavy import arrival from different part of the world. So, but at the moment, I don't see there is too many issues coming in next month for the supply of soybean from Africa.
No, Bharat, soybean importers, exporters are having a great time. Prices are good, life is good. Otherwise, getting a million ton from Africa, if you would have asked just a year back, people would have said not possible. Now
Yes.
things have changed substantially. With that, thanks a lot, Bharat bhai, for joining and sharing your insight from Africa, and wishing you all the best. Have a great season. After a long time, soybean traders, they're having smile on their face, and I hope this smile remain for a long.
Thank you.
Okay, so now we from the trading desk and talking about the numbers, let's move a little bit to someone who is working very closely with the farmers, and I think he will be having a bigger smile because the price, when the farmer is not being rewarded right with the right price, is where actually Suresh Motwani ji is actually not happy. Today, I think he should be happy. He might not be happy because of the yields and the productivity, but on the price, at least he would not have complained. So Mr. Suresh Motwani is our next speaker. He is a PhD and is an accomplished agriculture development expert, serving as the vegetable oil program head Asia at the Solidaridad Network. He specializes in designing large-scale international sustainability initiative and building multi-stakeholder partnership that balances commercial agribusiness growth with strict environmental stewardship. His core expertise includes developing regional certification standards such as Indian Palm Oil Standards Framework and driving smallholder farmers' inclusion across the global supply chain. Welcome, Sureshji. It's a pleasure to have you, sir.
Thank you, Deepakji. Thank you.
So, Sureshji, you are having a better smile than when we meet last time, right? The prices are good for the farmers.
Yeah, it's good for the farmers, but the actual question would be whatever the part of this higher price going to be the farmers. It's about the sustainability.
Yes, I agree, sir. But we believe, sir, at least it is better than the last year, where actually, the farmers were seriously struggling to even sell. In fact, that has happened. Farmers were waiting for a good price. It never came, and they were stuck with the cargo. And now they might be happy that actually, अच्छा है, माल रह गया था. We are getting a better price. So I think it's, I would say, sweet and sour situation, but at least not a bad situation.
Yeah, it's really happening actually. In the farmers in the central part of India, Madhya Pradesh, Rajasthan, they are getting good prices now. Yeah. The soybean more than 10,000 is going on in the seed, or the mustard also is more than 7,000 now. It's going on.
Right.
Yeah.
Right. I don't know who started. Okay, sorry. So, sir, now first question to you is that on sustainability, because I think that is something which is very close to your heart and my heart as well. So, how does the palm oil sustainability framework effectively balance strict environmental stewardship with the commercial realities of agribusiness growth? We are seeing that already, like EUDR and all that, they are pushing people to become more sustainable. And in the morning, we had a session about in which the palm oil was also discussed. And there is already a good premium being associated with sustainability. So how do you see that this framework evolving further, sir?
Sure. Deepakji, the first point I should say, the sustainability and the business should not be the separate actually. The sustainability should be the always part of the any good businesses. Nowadays, when especially we are talking about the edible oil or the more especially when the palm oil, a lot of the agenda around sustainability is there. And this context, when we talk about the IPOs, the Indian Sustainability Palm Framework, so this is one of the instrumental way where all the other practices what we are adapting for the palm oil production, for the businesses, for the transportation, it can be very well validated with the sustainability criteria. So when we develop this IPOs with the close coordination of the industry body like Solvent Extraction Association, even the palm oil institutions, IOPR. So this development is the way all the indicator sustainability, I can say the principles should be followed within the framework. And more especially, this IPOS is designed for the Indian scenario, the ground realities, the regional complexities. So in this way, this is doing very well. Many of the companies are already performing under the IPOS. And especially when we talk about the sustainability, not only about the IPOS, then we should, I can say, the agree. So nowadays, sustainability is not the privilege; it is the mandate. It should be mandate with the businesses. It's not looking into the doing the any concentration for the business. This is the prerequisite for the businesses. So especially on the palm oil, this is the burning issue. The IPOs can be the way forward, and we are really getting the good responses from the all stakeholders. Even IPOs is already endorsed by the Malaysian sustainability standards called the MSPO, as well as from the Indonesia for the ISPO. So this is going well, Deepakji, and I must say the Indian stakeholders, the businesses, their willingness to be justified their sustainability initiatives. IPOS is one of the way to be do so.
Right, sir. And again, I would also like to understand from you, what are the primary challenges in ensuring that the smaller farmers are genuinely integrated, right, without putting a lot of pressure, right, when we are talking about the compliance cost? Because whenever we talk about smallholder farmers, eventually somebody has to be at the compliance cost of any standard. How we can integrate them without much of friction, sir?
Sure, Deepak, this is one of the issue. We also do not expect the farmers should be pay the cost of the certifications. So there's a real challenges, especially countries like India, even the many of the countries in Asia or the Africa. The size of the land holding is very small actually. The small holding is there. So this is one of the challenge to do the financial feasible certification, documentations, adopt the any traceability tools. It's required the bunch of the lands. So this is one of the challenge. The second part is about the requirement for the different traceability informations to maintain the documentation in the ICS system, internal control systems. And the question is always there, who is going to be pay for this? So when I narrate these problems, I also have the solution based on our work, solidarity work with the smallholder farmers. So we propose to be these type of sustainability standards should be comply with the group system approach. We call the internal control systems where the farmer producer companies or the cooperatives can be further supported to maintain these all the traceability requirement, the documentation requirement, and through introduction of the different digital tools, the process can be easy enough to reduce the cost of these all the sustainability documentation requirements. But further, I should agree, this is not the only about the cost. It's all about the knowledge also. So I must say it is not about the willingness. Willingness is there from the both sides, for the industry, from the farmers. But to have the appropriate systems in place and the appropriate knowledge in place is the two tasks we really need to be addressed jointly. So the cost should be not only on the farmers, not only the industry, but the regulation system should have the support for the financial feasibility of the all sustainability requirements. I'm not doing the telling the government should do all things, but all the four pillars of the supply chain, whatever the farmer producer organizations, the businesses, the crushers, processors, and the government agencies, along with the brands, should contribute their costing in a way the sustainability should be addressed in the mandatory way. Yes, Deepakji.
Perfect, sir. No, this is very interesting, as you rightly mentioned. Eventually the end user has to pay, and when he's paying, the whole value chain should be able to take some little bit of, I would say, contribution to make it forward. Sureshji, last very pertinent question. In fact, Sureshji, if you can see that, we are also promoting Solidaridad, and then if you can see that, actually, it's just behind me because of the great work you have been doing, and I think among very few organizations which are having heart at the right place and putting those type of effort. And people like you are champion for that. And I've seen that with the passion you are having, right? Getting an Indian standard was next to impossible without the champions like you. So first of all, my wishes and congratulations for that. But sir, at the same time, when we are creating regional standards, the challenge is that the buyers always have the last laugh, right? So suddenly EUDR came and it is now sweeping regulation, right? And then the regional standards has to get, I would say, aligned to it. How do we create a global system where actually, the challenges of all the countries can be on the table, and then we come across standards which actually, even though they are regional, but they are able to interoperate pretty well with each other, sir?
Deepakji, first of all, thank you very much for this motivation for our work, what we are doing in the sustainability spectrum. So I must say, when we talk about the Solidarity work, so we are initially the international organization. We have the network of the organization. So whatever the global sustainability standards we are talking about for the different commodities, for especially in the palm oil, like RSP or the RTRS for the soybean or the bone sucro for the sugar cane or the BCI for the cotton. Solidarity is already the part of these all global initiatives. So what we are trying to be do by development of the national frameworks, our idea is to be prepare the bridge between the global requirement and the local realities, the regional realities. And in this context, we support the different national initiatives on the sustainability agenda. We support tea sector by developing the trustee framework. Similarly, for the palm oil, we supporting for this IPOS framework for India. Similarly, we supporting MSPO for Malaysia, and Indonesia, we are supporting the ISPO. The original idea is to be not to create the competitions between the different standards. The idea is to be do the matching for the local realities with the global requirements. So when we support the national initiatives, so these all national initiatives, standards, criteria are based on the regional realities, the local requirement, the local context, the local rules and the regulations from the different national governments. So this is the idea basically. So when we say that there are the global standards, there are the regional standards, there is the local standards. So our idea is to be prepare the different bridges between the all requirements. For particular company, for example, the Europe requires some certain specific certifications. So that it should not to the countries like India to be have the all standards for the all commodities. We should have the baseline. We should have our own national standards. This can be work as a base standard. Then based on the additional requirement for the standard like UDR, for the different climate related standards, then can be matchmaking. We can hone the add-on. For example, for the palm oil, IPOS standard is there. If we have the certain other requirement from the UDR, then we can plug in the additional requirement of the UDR. Then we can plug in the additional requirement for the climate agenda also. So this is a narrative basically. So we are trying to be develop these all bridges. So the sustainability should be the adaptable on the all levels. It's not only about to the big conferences or the webinars. It should also only the adaptation on the field level and recognized by the field level as well as at the government level or the private sector level. So this is the idea. So we support the national initiatives. Yes, Deepak.
Thanks a lot, sir. It's a pleasure to understand, the great work you are doing, and I think we have to match the two words come together and step in the right direction. Thanks a lot, Dr. Suresh, for joining this webinar and putting a very important perspective. And you rightly said, actually, in the start when we started the discussion itself, that sustainability and business should be seen as alignment rather than a contradicting approach. So thanks a lot for
So Deepak, if you have 1 minute, I should conclude
please.
the three major points actually when we talk about the sustainability. Now, so we should be clear, we are talking about the three core messages. The sustainability is the profitability is not the competitor. They are the go together. The smallholder is the key part of the all sustainability initiatives, and the future requirement is going to be address the sustainability criteria initiatives. It's not the only any privilege or the extra effort you are doing to be do. You have to do the sustainability initiatives to be sustainable in the earth. Thank you very much.
That was a great concluding remark. Thank you, Dr. Suresh. Pleasure having you. Thank you, sir. So now we move to our next speaker, and after sustainability, let's go to, I would say, the corporate cutthroat competition. And we are having a very aspiring company who is having Mr. M.K. Ved as CEO for Edible Oil and Poultry Feed, the Arise IIP. So he's a senior industry agribusiness executive, and he specializes in developing large-scale integrated industrial ecosystem that transform raw agriculture output into high-value processed products across emerging African and Asian market. His expertise encompasses managing multi-asset processing facilities, directional international trade flows, and driving regional economic diversification to sustainable business models. Namaste, sir. Good to have you.
Yeah. Good morning. Good afternoon. Namaste. How are you, Deepak ji?
All good, sir. God has been kind.
Yeah.
So thanks a lot, sir, for joining. To having such a influential voice amongst us is a great honor and a pleasure. So, sir, for my first question to you would be, what are the key strategic steps in developing large-scale integrated industrial ecosystem that transform raw African oilseed output into high-value processing good? Because we have been always talking about that Africa export commodities, it's not doing value addition. Even the local government also want the value addition to be there so that they have better access to the very important currency that is dollar. So according to you, actually, how to achieve it and how you have been able to achieve it, sir?
Yeah. So, Deepak ji, you rightly asked that earlier agriculture was the main commodity, and then Africa is known as to export the agricultural raw material commodity across the other nations, and instead the processing. But integrated value chain, we have seen that right now we are moving toward the integrated value chain in agri commodities. So I would like to say that there is a 5 important pillars that is very important for to achieve the complete ecosystem in agricultural integration transformations. So first important pillars I would like to mention here that is the secure raw material supplies. Raw material is important part of the entire aspect. So how we can get the secure raw material, that is very important for that. For this, the important that we need to give the complete ecosystem to the farmers. First, we need to get the complete offtake guarantee to them, and then we should provide the complete all the value added services like. We need to give them complete value, a good quality of the seeds, and then if it is required, the agrochemicals and all the technical how to get the better productivity. And we need to create the complete collection center also. That is very important and vital. So they can sell their product at a good competitive price. Then after we will able to achieve the complete secure raw material supplies. That is the first important pillars I would like to mention here. Second is that industrial processing side. So processing, not only the one sector or one part that is important, that complete value chain production processing is very important. I'd like to give an example of our industries, like soy industries. Not only the crushing plant, you should have the crush. Apart from the crushing plant, you should have your refining also. You should have your oil milling plant. You should have the poultry feed also. You should have your packaging. So whatever the productions you are getting, you can produce and you can sell to that extent locally. That you can create a complete ecosystem within the Africa itself. And third important part is that how you can utilize your byproduct, how you can create a value added for that, and how you can get all the supports out of that. For example, if you are getting the after the crushing the soybean seed, you are getting the crude oil and you are getting only the soybean meal. And you are doing the export that, and then importing the palm oil will not solve our purpose. So how you can utilize that, that is very important part for that. Fourth important pillar is about the logic sides. So if we'll fix up the procurement side, we will fix up the industrial processing side. Then important third one is that why utilize the byproduct within the country. The fourth really important is comes that how efficiently logistics work. Unless you will be competitive with the global standard, global market, you will not able to transform the entire Africa market. So your plant location should be very, very important. That should be very near to the port locations, or very important that your plant location should be near to your raw material procurement, raw material production centers, and all efficient logistics system should be there, so you can transform it very well and then do the exports. Arise IIP is doing the fantastic job in that side that they create the complete ecosystem. So you can put up your investment there, and you can get the complete ecosystem logistics support out of that. These are the fourth pillar. Or fifth important pillar, that alone the investors can't help to change the entire ecosystems. Important that all the government should also equally participate in that side. Financial institutions also should also equally participate in that side. And or the third one is that all the farmers and alignment trade body also should participate. That all should come forward. Then entire ecosystems would change, and then we can see that Africa ecosystems can be developed toward the industrial sides.
Excellent. Very well explained, sir. Actually, in fact, it was a master class in how to set up integrated ecosystem in Africa. Now, my next question to you that how do you manage the operational complexities and capital risk of running multi-asset processing facilities across African market? We know there are challenges in Africa, and that leads to risk, right? So when you are having multiple origins where you have invested, how do you take care of that part of it? Because the operational complexities in Africa are not easy.
Deepakji, you rightly said, unless you have the challenge, you will not make money. That is also very true. So how to face the challenges is very, very important. So you rightly said that first of all, important part I would like to start that you should have the good team members who can handle the entire operation very well. So not only the team members who has the experience in to handle the Africa market, but you should have the team members who has the expertise to know about the global market also. So all the global upside and downside movement, all the risk you can hedge it very well. That is very, very important. For this, what we are doing, or what is the what very, very core two principles I would like to mention. First, the integrated. That you should have the integrations. I mentioned here that don't can't invest on the single on the operations that we need to invest in the processing plant. You should have the investment in all integrations. Like for example, you should have your own power backup also. Unless you generate your own powers, because if your power is failure for 8 hours and you put up the investment, will not solve your our purpose on that side. So you should have the all the and logistic also. You should have their own logistic also, that where you can do the your exports and supply to the market about your finished goods product. Because the lack of the supply chain, lack of the logistics will impact your entire productions. So we should go for the entire integration. So similarly, what we are doing that we have complete our integration ecosystems. So we takes that help me as to manage the entire multi-sheet operations within the country. And another is important that when you select your plant machinery, should have the flexible approach. For example, if you are investing in soya processing, it might be possible that sometimes you will not get the soybean seed. What you will do that? So there is no other alternative. So you try to invest such a flexible manner that you should have the flexibility that either if soybean is not available, you can process the cotton seed, you can process the shea nut. So plant machinery design should be in such a way that you can handle you can handle all the odd points, and then you will get the flexible opportunity to run your assets throughout the year. So important part, Deepak, is that unless you run your plant minimum 80% capacity, it would be very difficult to make the money within Africa. This is our learning, which is why it is important that your fixed cost, your interest cost is and depreciation is too high in African countries, because you need to invest with good technology, good plant machinery, you need to invest in the good manpower. And that heavy, like not like India, so where the small investment will solve, you will get the raw material throughout the year. This is not the case. So unless you run your plant throughout the 80 to minimum 80% capacity, you will very difficult to make the money. So you should have that kind of the flexibility in your plant, so you can run the plant entire years. This is two principles. I would like to mention here that four important point in the Africa business that is very, very important and crucial, which we have seen and we have faced earlier also, and now how we are going to uh, outcrop all these challenges. First, important that price position risk, because you need to secure the raw material within the 3 month times, and your processing would be around the years. So your price position is too high in comparison to the India and other developed nations. So this is very, very important to how you manage your price positions, how you predict entire years. So India, you can change your strategy during the year or many times, and then in the global market, because you have the many hedging tools also. But for the Africa, very difficult to get the hedging tools, and because that is a non-GMO crop, important that there is no indirectly link with the global market. So you can't hedge your positions. So your call should be, you decide your call before the starting the seasons, how the seasons is going to operate in entire years. On basis of that, you should take a call on that side. This is one important part. We are doing the same thing. Before the starting of the seasons, we do a extensive discussion within our team members, how this crop is this year the market will going to behave, and we make our strategy in advance. So we should not be go wrong on that side, because 1 or 2 seasons wrong, matlab you are out from the African continent. That is very, very important part. So another is very important, the forest risk, how we are going to hedge your forest risk, because big quantity of the forest you are carrying. So what we are doing in generally, that if we are doing the export, if our business processing is within the Europe side, and we are putting the plant in the Benin, and we are managing our Benin plant, then there is CFA coordinated, there is no need any headache on that side, that is completely hedged. But if we are doing the export to US market and India market, it means we are completely exposed. The reason is that most of the trade happen in the dollar terms, and that is currency pegged with the CFA, with the euro. So in that sense, you completely exposed. So what we do generally, that whenever we do the trade with the according to that ratio, US and India, we generally take the funding in the dollar. So there is no risk on that side. When we get the export proceed, we will remit immediately to the for the working funding on that side. Sometimes that I've seen the Nigeria, so that if you are processing within the Nigeria and you are selling within the Nigeria, so better to take the funding within the local currency to avoid any forex risk. That is important part for that. So we adopt similar kind of the strategy during the our multi-seed operations. And third important part about the rate of interest, because Nigeria has the 24% interest. Many neighboring countries has a 5% interest cost. How you are going to manage all these, very, very important. So these are the important, that's experience play a vital role on this side. So we, with the extensive discussion within our team members, we reach and find a appropriate manner to run our sets efficiently.
Perfect, sir. So, sir, before I let you go, the last question. Which business model, you have explained already, like, the salient point, but which business model give resilience against the infrastructure deficits, right? So Africa also is having challenges that actually availability of infrastructure is always an issue. How do you take care of that problem in your view, sir?
So mostly our investment within our industrial zones only. So industrial zones has the better infrastructure in terms of you will get the complete throughout the year utility. There is no power, and we are very proximity with the port locations and railway route. And so the transportation would not be, is not very difficult on that side. And we do our own procurement centers within the country itself. So when I was in Nigeria, we were operating almost 20 procurement centers. So, on the help of the procurement center, we will procure and then keep the stocks within the country itself. Whenever our production is going on the year, we will keep lifting the cargo, because during the seasons you will not be able to get the all the trucks. You can't bring the entire cargo within the factory campus. Okay, so you need to find some strategy. So what we were doing, that we will keeping the stocks within upcountry only. Whenever as per our production requirement, we will keep bringing the stocks from the upcountry to our production locations to manage the entire logistics hurdles on side. Apart from that, when we are doing the exports, we are keeping one warehouse at the port itself. So whenever we get the excess productions or we are not able to get the complete order at the moment, we can shift the cargo from our factory to port locations. So we can, whenever we get the car export order, we can immediately do the shipments from that. On that way, we are trying to manage the entire logistic that help us a lot on this side.
No, totally agree, sir. So we have developed just-in-case model so strongly rather than just-in-time model for efficiency. That is how the Africa works. Thanks a lot, Ved Saab. It is always a pleasure and honor to have you. And thanks a lot for such a good advice for those who want to set up their shop in Africa, especially in agriculture and food sector. Thank you, sir.
Thank you very much. Thank you. Thank you, Mr. Deepak. Thank you.
So now we are having our next speaker. So from corporate, let's go a little bit on the cooperative side. So we are having with us Mr. Juma Bruno Nagomu. He is an agribusiness and trade professional currently serving as commercial director at Tanzanian Federation of Cooperatives, that is TFC. His work focuses on cooperative commercialization, market system development, trade and investment facilitation, value chain integration, and agribusiness innovation. He has worked with the cooperatives, farmers, private sector actors, development partners, and regional stakeholders to strengthen agriculture market, improve smallholder participation in trade, and expand opportunity in grain, pulses, oilseed, and emerging commodity sectors. His experience span business development, commodity marketing, investment partnership, digital transformation, and cooperative-led enterprise growth across Tanzania and East Africa. Welcome, Mr. Jomo. It's a pleasure to have you, sir.
Thank you so much, sir. And I would like also to applaud the HnyB and all the organizers for these sessions. It has been very, very interesting to hear from other speakers on how their roles and other transform the agribusiness and the food system in the world. Thank you so much.
My pleasure, sir. Thanks a lot for the appreciation. It really means a lot to us. So now first question to you, sir. How is Tanzania Federation of Cooperatives leveraging digital technology, including digital financial technologies, to modernize the rural framework and empower the smallholder producers?
Thank you so much. That's a very good question. But I would like also to start by introducing the Tanzania Federation of Cooperatives in a few seconds. We are the representatives of all the cooperatives in Tanzania. Currently, we have in Tanzania now we have more than 6,500 cooperatives in Tanzania, which translate to more than 10 million people in Tanzania. If you're talking of 60-something million people, the 1/6 of it are the members of cooperatives. And as the member of International Cooperative Alliance, TFC mandates goes beyond the representation of the cooperatives, advocacy, and others. According to the ICA now, the cooperatives have to do business. The cooperatives have to be independent as they were before. And doing that, the digital inclusion and others should be the drive of cooperatives because they are the one doing business. So in recent, there has been a lot of advancement from the regulations in Tanzania, and from 2025 regulation or the law is that now the cooperatives are more independent. They have to do business, and before the regulator was the one to do or even the issues on promotion. But now the Tanzania Federation of Cooperatives have regained their mandates to promote, to educate, and even to represent the cooperatives. But again, we are responsible also to do trade facilitation, investment linkages, as well as digital transformation to members of cooperatives. And the numbers I shared with you are the 6,500 cooperatives. 2/3 of them are there in the agri sector. So we have more, I think recently you have heard about the transformation that has been done in Tanzania, even the digital transformation, the digital marketing, the mercantile exchanges and others in the agri sector, as well as in the minerals. So with all that, we see that digital finance is becoming a practical tool for financial inclusion as well as transparency and market access within the cooperative system. And to answer that is that TFC, our focus with all the transformation is not only in the technology adoption, but at the same time in solving real operational gaps affecting the farmers and the cooperative societies. And we are encouraging use of mobile payments, digital record system, and accessibility tools. And even I know some of the cooperatives are also have joined, have accounts in the world trading platforms, including the AgTrade and the AgriGuru online. So this help reduce cash leakages, strengthening accountability, and build financial histories that can support access to credit and insurance. And I wanted to update you, Deepak, that you met Professor Nyange during one of our events in Tanzania. That the Professor Nyange is working on the credit score for the cooperatives in Tanzania. And recently, we are also included in the Vision 2050 for Tanzania, because if 70% of the capital transactions have to be achieved through the private sector, the cooperatives are engine for that. The cooperatives now in Tanzania have invested massively, not only in membership, even in taking care of the infrastructure, plating the warehouses. The cooperatives are the transactions which are being done through the digital system, the warehouse receipt, and even the financial payment are being done. Our own cooperative bank, the Coop Bank of Tanzania, which is also part of the area that we at TFC applaud ourselves of, is the transformation of this cooperative bank, which is now transformational. Even the cooperative bank itself have now delved into the digital economy or digital systems. We are using the app. We are using when the farmers are registering their accounts, it is not normal. The financial services are now connected using the mobile payment and others, as I mentioned before. So for us, it's not just the technology, but rather the way that we look that the members value, the member data, and also the transactions have to be done on that, and even the adoption of other digital platforms.
Perfect, Mr. Juma. So now next question would be like, we have seen that one of the biggest challenge when it comes to Africa in general, and East Africa in particular, in Tanzania, we have seen that the government is trying to find better ways to get better realization for the farmers when the export happens, because Tanzania do export a lot of oilseeds and pulses. How do you see that cooperative playing an important role in ensuring that there could be a better market linkages from farmers through cooperatives with the international buyers?
Thank you so much. That's a very, very interesting question. And I also have to applaud the government of Tanzania and other development partners and our colleagues before, who are working very close with the farmers. At our level, as I said before, the cooperatives now they are doing business. One of our role is contract farming facilitation. I didn't want to mention it before because this is one of the interested area that the cooperatives are doing, because we have different type of cooperative. We have the primary cooperatives, which are more of the agricultural marketing cooperatives, and then you have the unions, which is regional based or the sector based cooperatives, and then you have the joint enterprises. And these joint enterprises, the combination of different cooperative unions coming together and forming a company so that they can compete and deliver the services. So with all that going on in the world and in the business area, is that our role at cooperative is not just in production, is not just participating in this digital trade, even the production. Our roles, we see our members now engage in seed multiplication, having contract with the seed companies to produce seeds that can be used to produce grain for processing to get the oil and other food product. But at the same time, we have seen the cooperatives coming up and improve their storages and infrastructures. And this one will not only able them to store the commodity, but at the same time to give ample time so that even during the high season or the low season, they can still maintain and wait for the good prices and others. One of the colleagues mentioned here about the issues of AUDR and other compliances. For us, the cooperatives are the center for that. The cooperatives are the one that will not just produce for you, but will give you able for you to do traceability, to work close in terms of the contract farming. And when I say contract farming, it's not just when you work with a cooperative, you will not work with other regulatory authorities. And this has to be understood very much to all the stakeholders. In countries like Tanzania, which is part of the Africa, is the relationship that you have with the business partner that will drive you. But you have also to follow the regulations. In Tanzania, before we didn't used to have the board that regulate crops such as oilseed. But now we are lucky that we have the cereals and the other produce regulatory authority, which is working very close with all the stakeholders, including the cooperatives. And I was lucky to be part of the team during the formation, the formation of this COPRA into operation. And so the system is very well coordinated. The contracts and traceabilities are even done digitally in the online platform that are accessible to every partners who have the accounts or who are willing to enter into contract to that. But at the same time, the cooperatives themselves are also engaging in the primary value addition, which is the primary processing. And according to the new regulation is that especially on the sunflower, is that you're not supposed to sell the virgin sunflower. You have to do the refinery. So we see the cooperative coming up together to do the primary processing after production, and of course storage, but going together and have the contract with the big processors for doing refinery. So we see the cooperative coming together, comply, but at the same time having the contracts for continuous supply to these investors in Africa and Tanzania, and doing that, we are looking to make sure that we provide more education and awareness to the members of cooperatives. So issues, markets now require ESG, the environmental, social, and governance alignment, traceability, and of course, food safety standard and others.
Perfect. Thanks, Mr. Jumo. It was a pleasure talking to you, and wish you all the best. And I think in India also, we are pushing for a cooperative model to be successful. And I hope our brothers in Tanzania, our farmer brothers in Tanzania, will also get benefit out of that. Thanks a lot for joining, sir. Pleasure having you.
Thank you. But I would like to end by also inviting our colleagues and partners from India and the rest of the world now. As the world is moving, we need to work more on the organized and even the issues on digitalization to support our farmers, because the cooperatives are the engine and the spine of the agriculture in Tanzania. And I hope the same is across the globe. Thank you so much.
My pleasure, and invitation accepted, sir. July, I will be in Africa, and definitely I'll come and meet you. In fact, I'm very interested in working along with you on the coming out with the credit numbers for the cooperative. I have those expertise, and I think I can maybe add some value by sharing my experiences, sir.
Sure. Let's keep connecting outside this avenue, and I'm looking forward to have further discussion with you and all of the stakeholders in this platform. Thank you so much.
Thank you. So now, with that, we come to our last speaker for today. We are having Mr. Pavlo Javornoisko. He is an astute agriculture executive and commercial trade leader, serving as a director of Falcon Agro Group LLC, which processes soybean into soybean oil and meal. His expertise lies in technical and technological aspect of processing, with multidimensional experience of working across multiple functions. Pavlo, pleasure to have you, sir.
Hello, everybody. Good afternoon. First of all, thank you for invitation. I have some problems with video connection, so I will be able to answer your questions without using the video camera.
Perfect. Not a problem, sir. Not a problem, sir. So, based on your experience with the recent volatility in the domestic soybean quality, what specific technical adjustment are you making during the conditioning and cracking stage to ensure that optimal oil extraction and high protein retention in the meal is possible, sir?
Oh, thank you. This is a good question, especially for us, for Ukraine in this season. This season, soybeans quality is very different compared to previous year. We see large variation in moisture, oil content, protein levels, and being damaged depending on region where soybeans come from. In general, this season, soybeans have lower oil content while protein levels are mostly stable. These changes are very important for processing results. Oil content plays a key role because it affects both production efficiency and economic performance. Because of this variability, we must adjust our processing conditions much more carefully and flexibly than before. So, at the conditioning stage, we have strengthened our quality control for incoming raw materials. We check each batch more carefully before processing. We adjust moisture, heating temperature, and holding time depending on the specific characteristics of each batch. These adjustments help us to prepare the soybeans in the best possible way for processing. They also help reduce losses and improve overall efficiency. During conditioning and flaking, we pay close attention to flake thickness stability. Since raw materials are not informed this season, we need to adjust the roller settings more often than usual. This helps us to properly open the cell structure of the beans. As a result, oil extraction becomes more efficient in the next stages of processing. We also focus stronger on the hulling efficiency. Removing as many hulls as possible is important because it increases the protein concentration in the meal. It also helps us meet strict export requirements, especially for markets in the European Union. One of the main challenges this season is the low oil content in soybeans. This directly affects the production of high protein meal. Our main goal is to extract as much oil as possible and increase protein concentration in the final product, which is a defatted meal. However, when the starting oil content is low, the final increase in protein is also limited. This is one of the key technical challenges we are facing this season. One possible solution is to use blading. We mix different soybean batches with different protein and oil levels. For example, we can combine soybeans with higher oil content and lower protein with other batches that have different characteristics. This helps us achieve a better balance and more stable production results. All process parameters are monitored in real time using our production control system. We also regularly compare this data with laboratory test results of the finished products. This allows us to quickly react when raw material quality changes. Overall, this season shows that success depends less on changing technology itself. Instead, it depends more on how quickly, accurately we adapt our process settings to each individual batch of raw material.
Perfect. No, I totally understand. This is a challenging year when it comes to not just on the quality aspect, but also we are seeing that challenges of infrastructure in Ukraine. And I thank you, sir, even in the current situation, joining and sharing your views with us. So my last question for you would be soybean, we know it's a pretty sensitive crop, especially when it's about moisture or heat stress. Given the current infrastructure challenges in Ukraine, what are ways and means you are monitoring and ensuring that actually you are able to store the seed in a right way so that it doesn't get degraded?
Are you talking about storage in the soybeans?
Yeah, storage of soybean, yes, sir.
Okay. In this season, for us, soybean quality during storage is one of the most important factors. Not only for us and other plants who do processing soybeans. It affects oil yield, milk quality, and overall production efficiency. That is why our approach is focused more on prevention, not fixing problems after they happen. We use a multi-level monitoring system in all our storage facilities. Every soybean lot is first cleaned and dried to save moisture level before storage. During storage, we regularly monitor temperature and moisture. We use automatic sensors installed inside the sealer to track conditions in the real time. So, one of the key priorities is early detection of self-heating. If we see many increase in temperature, we react immediately. We start aeration or more grain to another sealer to stabilize the condition. During warm period, monitoring becomes even more important. Higher temperatures increase the risk of quality loss and higher free fatty acids levels in the oil. We also regular laboratory test stored soybeans. We check moisture, damaged beans, and oil acidity levels. This helps us to detect problems early. If needed, we can give priority to certain lots and send them to processing earlier before quality decreases. Because of infrastructure challenges in Ukraine, backup power systems are very important for us. We ensure that monitoring and aeration system continue working even during power outages. Overall, our strategy is based on constant monitoring of soybean quality. We try to reduce storage time for sensitive lots and react quickly to any changes. This helps us to keep our soybeans quality stable in the wet uses before processing.
Perfect. Thanks a lot. I appreciate your joining, Pavlo. I know, the situations are not that great in that part of the world, but wish you all the best, and I look forward to have more engagement and interaction with you. So with that, we come to end of this second session today on oilseeds and edible oil or veg oil, and looking forward again to see you join in our upcoming next session, which would be focused on South and North America, same commodity, that is oilseed and veg oil. And we'll be starting at 9 a.m. New York time or 6:30 p.m. Indian Standard Time. We also have 2 more days, tomorrow and day after, where tomorrow we'll be talking about pulses and then day after about sugar and soft. So with that, I would like to sign off as your moderator. Looking forward to see you soon again. Thank you. Have a great day.
Thank you. Thank you so much.